Okay, let's get started. Good morning. How's everybody? Good. All right, we're marching toward the very last two chapters. We have a little bit of chapter 12 on preferred stock, and then we'll move on to chapter 13. Chapter 13, relatively compared to other chapters, is about just half of the size. Okay, so we're going to finish chapter 13 this week, and then start, for the most part, of chapter 14 also. Okay, so we're marching toward the last two chapters. We have a little bit left of chapter 12. We started 12 on understanding more on balance sheet, this specifically stockholders' equity section. If you remember, balance sheet breaks down to assets, liability, equity. Equity, by definition, is net worth of the business, and it breaks down to the part that earnings company actually earned by themselves by providing goods, services, which later produces into net income and factors in retained earnings. So this part is internally generated fund. There's another side of equity, externally generated fund, by issuing common stock, preferred stock, and also today on Wednesday we'll cover treasury stock. Later on, perhaps companies may also buy back some of the stock. Okay, now with part two, common stock and preferred stock, sometimes companies may decide to reward shareholders for the external capital that they provided for the business. So this is the thing that we call dividends. Dividends is like a gift to shareholders based on companies' operations. They may decide to give out dividends, they may not. So this is a call for the board of directors. But if they do decide to give out dividends, there's two entries to this. Okay, first is declaration entry. Remember, it usually starts somewhere close to the end of the season, but not exactly the very last week. So oftentimes 3 to 4 weeks before dividends is actually paid out. So last week we talked about dividends. When we declare dividends, we would journalize reduction of retained earnings and then also dividends payable. Okay, you also have a homework assignment on this concept. Dividends payable, retained earnings is being reduced because this is a gift to shareholders. It reduces what we eat up, what we accumulated earlier. Okay, but when it comes to payment, so that is a declaration entry. When it comes to payment, we'll be reversing dividends payable and then paying cash. Okay, so this part here is cash dividends. Today we'll also be going into a topic on stock dividends. Cash dividend, basically that means the gift is cash itself. Later on, if you and I are shareholders, we'll be receiving checks from company. That is the idea of cash dividend. Okay, today we'll go into another topic, stock dividend. Basically, the gift is not cash, but other stocks issued by the company. Okay, now for cash dividend, when we want to divide cash dividends between preferred shareholders and common shareholders, this is the way how we divide it. Okay, and then preferred shareholders also breaks down to two types. If it's cumulative preferred shareholders and non-cumulative preferred shareholders. Okay, so this is an example that companies issued either $5,000 or $50,000. Now remember that dividends is calculated based on percentages of face value. Okay, so percentages of face value, if we look at this example, it tells you a company has 2,000 shares of $50. This is a preferred stock. Face value is 50. Altogether, they issued out 2,000 shares. The dividends rate is 6%. So to calculate the total amount of dividends that preferred shareholders is entitled to get, that will be 2,000 shares times the face value of each share times the rate of dividends. So altogether, this will give you the dollar amount, $6,000. This is the part that preferred shareholders is supposed to get every year as long as company declared out dividends. Okay, now remember I talked about a case of cumulative and non-cumulative. For the most part, preferred shares are cumulative. Okay, then the homework problem that they gave you, there's one problem that breaks down to cumulative and non-cumulative, just so you have a sense of how it works for both cases. But in the real world, usually preferred shares are actually cumulative, meaning that the dividends that they did not receive this year will carry on to the following year. They have the right to receive the difference that they did not get this year. Okay, for example, the upper example here, case A, total dividends amount is $5,000. Remember, preferred shareholders, they are they're supposed to get $6,000. So the differences between this and what the company actually gave out, the $1,000, will be added to next year. Okay, so meaning next year, if, let's say, company this following year has a better operation compared to last year, if they gave out $8,000 of dividends, then again, preferred shareholders will be getting $6,000 plus the missing $1,000 part that they did not get in the previous year. Okay, so cumulative means that the dividends amount for preferred shareholders will be added on to the following years if they didn't receive the full amount in the previous year. Right, so the upper example here, you see preferred shareholders, they get $5,000 in full because this is the total amount that company is able to declare out to their shareholders. And since this is even less than what preferred shareholders is supposed to get, then common shareholders will be receiving 0 in this case. Okay, we always consider what preferred shareholders will be receiving first, and then whatever is left goes into common shareholders' hands. Okay, so in the following case is an opposite example. If company this year, they're doing pretty well, they got a lot more than they expected, and now they're issuing out $50,000 of dividends. In this case, since $50,000 is a lot more than $6,000, obviously, whatever preferred shareholders is receiving, there's going to be leftovers from that. So altogether, the leftovers will fall into common shareholders' hands. Okay, so these are two independent cases, giving you an example of in case dividends are even less than what preferred shareholders is supposed to get, then all of it goes into preferred shareholders' hands, and that $1,000, the missing $1,000 between $5,000 and $6,000 will carry on to the following year. So next year, preferred shareholders will be getting, they are entitled to get $7,000 instead. Okay, now this is an example that companies issued out a lot more than what preferred shareholders is able to get. So in this case, common shareholders also gets dividends. Okay, so companies, they always consider preferred shareholders dividends first, and then if there's anything left, that goes into common shareholders' hands. Okay, so this is a cumulative case. If there's missing amount this year that they didn't get, it will carry on to next year. In case the preferred shares, the problem specified is non-cumulative, then that basically means after the first case, preferred shareholders this year, they only get $5,000. Next year, that missing $1,000 doesn't carry on. Okay, so it's just the opposite of a cumulative case. So next year, starts fresh again, preferred shareholders is still only entitled to get $6,000 rather than $7,000. Okay, so this is non-cumulative, this is cumulative. Next year, one of them gets $7,000, they have the right to get $7,000. Otherwise, they would just still be getting $6,000 of whatever the company declares. Okay, any questions to dividing dividends? This is very important. Okay, this idea of dividends, how to divide between preferred shares and common shares is very important.